Hey Jordan, can you hear me?
All right, perfect. There you are. How's it going?
Good, good.
Good. All right. Well, are you good? We'll kind of jump things off.
Yeah,
Okay.
absolutely.
All right, perfect. Um, well, thank you everyone for your patience. I'm Jordan Fry from the Prudent Plastic Surgeon, and I'm excited to be joined here by the team from DocWealth, including Laxman. And they are a physician-founded tax advisory firm who have been doing really great things, helping physicians to manage their biggest expense, which is always taxes. And so Laxman's going to take us through what it'll be a really exciting presentation, kind of going through strategies and things like that, and then also ending with a real case study from a physician client of theirs, which is always super helpful to see. So thanks everyone for joining, and Laxman, I'll let you take it from here.
Thanks, Jordan. Appreciate it. I'm going to share my screen. Just give me one second while I open up our deck.
No problem.
Okay, cool. So just figuring out the sharing option here. Let's see. Do you know where I can share on here, Jordan? I'm trying to find the sharing option.
You should have access. It's at least for me, kind of in that bottom row, kind of right in the middle.
Okay. Oh, I see it. Okay. Got it. Let me be able to do that. Can everyone see my screen?
Yes.
Okay, perfect. Well, thanks everyone. I'm Laxman. I'm a co-founder at DocWealth. Um, and co-founded with my college roommate, Mark Applegate, who's an emergency medicine 1099 physician. We really started DocWealth about 2 years ago. The goal was that, Mark, my college roommate, he wasn't able to find a CPA that really kind of focused on different tax strategies. Most CPAs are really focused on, let me talk to you year end and file your taxes. When you're in this income bracket, there's a lot of opportunities, whether you're in real estate, or W-2 or even 1099 or own your own practice. Um, the tax code is 75,000 pages, and it's very much catered to anyone that is either starting their own practice, real estate, or 1099, as I mentioned. And so we started this 2 years ago. We work with about, more than 400 physicians right now. And our team is pretty diverse. We have a tax attorney as well as multiple CPAs, enrolled agents, bookkeeper and entity formation experts. So, um, just a little bit about us. So just kind of digging more into what we do. Um, so again, we focus on the three different profiles that I mentioned, more than 400 physicians. And so I think the first part where I'd like to kind of dig into is W-2 versus 1099. When you're W-2, there's not a lot that's open as in terms of tax strategy. It's really down to three different strategies. One is real estate, which is the most common. And when you think about real estate, you have the opportunity between, getting rep status, doing long-term and short-term rental versus, being more passive. And where the real benefits really lie is more in when you are able to achieve active status on real estate. And what that really means is that, let's walk through an example. If you buy a $500,000 property, and you achieve, active status, you are able to accelerate the depreciation on that property. For example, 2025 is a very popular year because Congress just passed the new tax bill, which allows 100% bonus depreciation. And so in that example of 500,000, um, typically building value is about 60%, land value at a high level is 40%. you can accelerate a large portion of that building value. So on average, we typically see about $150,000 out of that 500,000 is eligible to be deductible against your income. So if you're making half a million, now your taxable income is 350,000. That's taking away from the highest tax bracket, especially if you're going to be hitting that 37% federal as well as state. That's about more than 40 cents on every dollar that you get back in your pocket. And why this is important is because in finance, it's all about time value of money. And if you have more cash in your pocket right now, say 40% of the 150,000, that's about $60,000 in cash back in your pocket that you can reinvest even from a high yield savings account to other investments that could, S&P that can return you 7, 8%. So this is extremely valuable. And it's money that legally doesn't have to go to the government or Uncle Sam. Um, but when you talk about real estate, and I'll kind of delve into more in detail, um, let me actually pull up a different slide into the real estate side. Apologies, 1 second. So in the meantime, is this already open where people can ask questions? Because I'm gonna go through a lot of information. I want to make sure that this is very interactive and that as I'm talking about different topics that we can address them as well. Um,
Yeah, certainly. If anyone has any questions, feel free just to go ahead and unmute yourself and let us know, or if you want to put them in the chat as well, and I can read them out. So yes, certainly throughout we'll be looking for questions. Okay, Richard is saying the slides are a little small. I don't know if you can do it where you blow up, the whole slide.
yeah. So let
Cool.
me see. Mm, sorry.
My name is Frank. I am a nephrologist in private practice. I just want to ask a quick question out of the gate.
Yeah.
Uh, Obviously, I have a CPA that I work with. If I see value in what you have to offer, how does that work? My general understanding is, you know, I'm sort of have to maybe have to change from them to you guys for this thing to be meaningful, i.e., you guys can do your calculations, but they will not apply it. Is that kind of how this works, or this is any different?
Um, you mean when so a lot of these strategies, it's applicable with anyone that you're working with. But the most important is that whoever you're working with has to understand the strategies. Because when they file the tax return, if they don't understand the strategies, they won't know where to input, what the documentation, what is the support that you need, right? And so that's probably the most critical. Because whoever's signing the return, when your CPA is signing the return, they're putting their license at risk, right? And so most CPAs will never take the work of someone who's doing tax strategy, if you're doing cost segregation or any of these strategies, and file for it. They'll basically say, "Hey, I don't know how to even input this information in the tax return or such." Does that answer your question?
It does. It does. What that means is that to be able to implement this strategy, then you have to change, I guess, CPA firms, or is that
Yeah, yeah, essentially, that is
okay?
typically what's most recommended, I would say.
Thank
So
you.
I almost have this deck ready. Oh, geez.
Oh, here's another question that came in. Um, how can a W-2 employee get professional real estate status? Unlikely, right? Unless it's your wife.
Great.
Yeah.
Yeah, that's a great question. Um, so kind of digging into that. And so just, is it big enough or do I need to,
I don't know if you can if you go to slideshow and just do the
yeah,
play slides or
okay, play slides. Mm,
like if you go Sorry, like toward the bottom of the screen.
Oh yeah, I think
Yeah.
it's. Oh, there it is.
Yeah,
Okay.
perfect.
Okay.
Continues. Yeah,
Okay. Yeah.
great.
So yeah, great question. So to do when you have a long-term rental property, for example, and you want to do cost segregation, which means that you're doing the bonus depreciation, um, you or your spouse has to their majority of their time has to be spent in the real estate realm. And how the IRS tracks this or approves this is that you need to be able to show 750 hours on paper doing real estate activities. What is a real estate activity? Driving to a real estate property doesn't count, but that means like if you're researching properties, talking to a real estate broker, studying for a real estate license, going checking out a property, um, all of that counts, but it's 750 hours, and that's about 15 hours a week on average. So pretty significant. So if you're a full-time physician, it's very hard to be able to defend this. In the case of you ever get an audit. So what most do, in the physician that we work with, usually their spouse is if they're part-time or they're stay-at-home, great candidate because that then doing any amount of time in real estate will be your main job as well as they can, even studying towards real estate will count. So 750 hours is pretty doable. For example, my wife does not work. And I try to buy, a property every year, and then she has rep status. And so we're able to achieve that, for example. But if you want to bypass this, the only way is to do a short-term rental. And you've probably seen a lot of, on Instagram and Google and stuff, especially in the last couple of weeks. If you do a short-term rental, you do not need a 750-hour requirement. You all you have to do is that active participation and 100 hours, so meaning that no one else can spend more time on the property than yourself. That means you cannot hire a property manager. And so one way around this, what we typically do is this is all matters in the first year because this is when you're accelerating the depreciation. If you buy a property in the last quarter of the year, so say like September, October, um, it has to be ready to rent out and likely have one person rent it out on Airbnb or whatever, then it'll qualify. And then come the following year, January, February, March, you can decide to move it to a property manager. It's that first year that you really need to make sure that you're checking off all the check marks in terms of no one is spending more time than you. You have 100 hours related to that property because typically if you're going to do a short-term rental, getting it ready for Airbnb, it's going to be 100 hours. But 100 hours isn't as much anywhere close to 750. Any questions on that? I know that was a lot of info.
No, that was a great rundown. My wife does reps as well, so similar type of thing.
Yeah.
Quick, a couple quick hitting questions, and then we can get back to your
Yeah.
slides. One is just can the services that you provide with DocWealth, can they be deducted? Um, the
Yes.
answer is yes.
Yes, that is correct. So yeah, everything with tax strategy, tax filing is deductible. And so if many of you are in that 30-40% highest tax bracket, then that's basically the discount that you're getting. And the way you want to think about taxes is not your effective tax rate. What that means is that effective means your average tax rate, right? Our goal is to chip away from your highest tax rate. So many of you, if you're married filing jointly, you're in 650,000, you're paying the maximum 37% federal. That means that every dollar that we can get down to the next lower tax bracket of 35% is 37%, 37 cents back in your pocket. So we're trying to get you from the highest, like 37% federal, and then as low as you can go. And so an example at the end, I'll walk through, a physician that we work with, and we brought them down from 37% down into like the low 20s, for example, but just by doing different strategies.
Awesome. I'll have you kind of get started in this. There's a couple other questions finally that we can kind of um,
Yeah.
get to as we go along. So Thanks, Laxman.
Yeah, totally. Um, and so yeah, I mean, so let me go to the next one. So there's a big difference between filing and strategic planning. And the biggest thing here is being proactive versus reactive. When you get to January 1st, 2026, it is too late to do tax strategy. There's very minimal things that you can really do. So most of the strategies that I'm mentioning and talking about, the big ones, you have to do in the actual tax year to be able to recognize it on your tax return. And so that's why, for example, right now we're in peak strategy mode where we are working with everyone and okay, what are your retirement accounts? Are you looking to buy a property? Because it takes time to go buy a property. Are you looking at oil and gas? Oil and gas is another really popular one, where essentially you get a K1 for investing in an oil and gas investment, and you can deduct about 85 to 90% of that investment against your taxable income. Why this is very popular? It takes really no work on your side. You just make the investment. But on the other side, it's important to note that it's an investment. So there's risk associated with this, meaning that unlike real estate, which is a pretty safe asset, in oil and gas, the fund has to be able to hit oil, and how much they hit oil really kind of dictates your overall returns. So you may be able to deduct 90% in the first year, right? And so you invest 50,000, you deduct 45,000. It's a great first year return. But after that, to really get all your money back, you need distributions as well. And so we facilitate, make introductions to different oil and gas companies that we work with. Anything that we do, I'm a big believer that as your tax advisor, it should be very objective and neutral. So everyone we work with, there's no incentive on our side whatsoever. Our goal ultimately is to kind of give you opportunities, streamline, facilitate it so that you can kind of make decisions and put yourself in a place where you can, get a ton of tax savings. And so reactive versus proactive. And so the goal is that you are having multiple check-ins with your tax strategist because every strategy takes time to implement and each person has their own nuances. What state you're located in? Do you have kids? Am I getting my parents on payroll? So all of these things take quite a bit of syncs with your tax strategist. And so as more advanced that you can do, we typically say you want about 4 months minimum in the year to be able to really maximize. And then doing it that way, you can range anywhere. I think most star physicians range from 30,000 deductions all the way to a couple 100,000, right? And if you're able to save even 30,000 deductions, that's probably safely around $10,000 in cash back in your pocket. And then yes, the most important thing is everything has to be customizable to you and your personalized situation because every element of what's going on with you, where you live, the family, investments you have, all dictates, what the strategy is and what makes sense for you. And so you can kind of see in the bottom right where it kind of compounds. And each year that you do tax planning, there's a significant ROI as you kind of go throughout your career and enter into retirement. Uh, Go to the next ones. One more second. Okay. So we talked a lot about this. And so I like to think about tax strategy in different layers. What's the easy, low-hanging fruit, and what gets more complex? So, for example, when you own real estate, you immediately become a business owner. So that enables you to start taking other deductions. So the first one is general business expense deductions. Anything that's related to real estate, whether it's your car, the mileage, going out for a meal, as long as it's related to the real estate activity. If you go, with a family trip to, say New York, and you go and attend an open house, and you track that you actually attend an open house, that trip becomes eligible to expense, right? Many times people like to employ their kids. We say, moment they hit 9 years old or older, it's pretty defendable. 9-year-olds are pretty impressive these days with what they can do with a computer. Um, And so we have a lot of kids that just help with admin things, whether it's emails or just Excel or organizing things, cleaning the home office, and then getting paid a reasonable wage, $20 an hour. And this is great. Why it's great is that it is completely deductible for you, and they don't have to pay taxes up to that, about $15,000 this year, for example. So they can invest into an IRA or their 529C, and it grows tax free. And for you, you don't pay any taxes on it. So that's a great strategy. But with everything that you do, um, whenever the government doesn't get their money, they want to make sure that you are checking every box on the compliance side. So the kid has to get a W-2. You can't just transfer money to them. You have to say, hey, this is a job description. This is how many hours they worked. And we kind of streamline this by giving you a template of examples and how you can track the hours and make sure that they get paid a W-2 at the end of the year. Um, the next one is this retirement plan contributions. Um, this is great. If anyone here is a 1099, um, typically a SEP IRA or solo 401k, you can contribute up to 70,000 on like 23,500 in a W-2. When you have real estate income, you can also use that, say 25% of the net profit can go into a SEP IRA, which is on top of your individual 401k that you may have with your job. So retirement plan contributions are very powerful because everyone wants to invest and have enough money once they retire. And if you're able to have a deductible investment, that's extremely powerful over time. The third one is home office deductions. This is a room or space in your house that is not used for living purposes that you can say that this is solely for work or managing the real estate. And as long as that space is enclosed, you can look at what the square foot that represents of the total home, and you can start deducting that percentage of the mortgage interest, property taxes, utilities, a lot of things, and that's adds up as well. You can get a little bit more creative in that if you're doing any kind of renovations or buying artwork and that's kind of dedicated to that home office, then whatever is in that home office is 100% deductible. Um, and then ultimately, I think health insurance premiums, if you're, 1099 as well is eligible as well. So all of these tend to kind of range from like a few thousand up to 70,000. The bigger ones is what I was mentioning is like real estate, oil and gas. You really have to make a large investment to get a large deduction. Um, Maybe I'll just pause here because I'm sure there's a ton of questions on this as well.
Yeah, we can go through some.
Yeah.
First one says, as 1099 filing as an S corp, can we pay ourselves overtime for hours worked over 40 hours? Is overtime not taxed under the new tax bill?
Yeah, so the new tax bill over time is for very specific roles. Um, we're still kind of delving into it, but I'm pretty sure that um, physicians aren't applicable for that. Um, is that the exact question?
Yeah, that's what it seems like, and that's my understanding as well. Like it's sort of meant like for almost like barbers and like very
Yeah,
specific jobs.
more blue collar, I would say,
Yeah.
is eligible for that. Um, yeah.
And then for a C corp, are there any positives with the new tax bill?
So C Corp. So just to clarify, you don't mean like PC, like professional corporation. This is like a true like C Corp that most companies in the S&P are, for example, right?
That's one thing, Syed. If that's not the case, let us know. But that's yes, I believe that's what they're referring to.
So for most cases, what I would say is that a C Corp, if you're an individual or have a small business, most of the time C Corp does not make sense. It can make sense. It gets definitely more complex and it has many more requirements. And the reason for that is C Corp is double taxed. That means you get taxed at whatever the business is generating. And then when it gets distributed to you personally, you also get taxed again. So the only time it's really good is when you have multiple shareholders for compliance, for risk mitigation in terms of litigation, um, as well as, you're really not looking to pull the money at all. You're trying to keep it in the C corp at the 20%, and then maybe later on, when you're at a different tax bracket, you're like, okay, I want to pull this out at this point. But I would say for most individuals or small businesses, I almost never see a C corp structure at all.
And then Frank, I'm not skipping your question. We're going to come back to it. Bryce is asking, how do you decide between uh, a solo 401k or a SEP IRA for a 1099 physician?
Yeah, that's a great question. Very common. Um, so the SEP IRA essentially is great if you have a combination of W-2 and 1099. Um, and it's really a math equation at the end of the day because with ESEP, if you have an LLC or an S corp, you can contribute 25% of the net profit that you're making in your business, all the way up to $70,000. A solar 401k, I typically say if you're a pure 1099, it's always going to make the most sense because you can contribute 23,500 for the individual side. And then since you're your own business owner, the employer side can contribute the remaining amount to get up to 70,000 as well. Um, and it's also the 25% of net profit. But why the solar 401k is so powerful is that you can do a mega backdoor Roth on a solar 401k. You can't really do it with a SEP IRA. And what is a mega backdoor Roth? You can all of this is pre-tax, right? Typically, you can convert it into a Roth, and essentially that then grows tax free. And and if you're making investments, typically whenever you pull out the money, you have to pay capital dividends if you've held it more than a year or some sort of ordinary income tax. But with a mega backdoor Roth, at the time you retire, you pull all the gains or the increases. You don't have to pay taxes on any of it. So a lot of the people that we work with are actively, contributing to the max 70,000 and then doing the mega backdoor Roth. Um, does that answer your question?
Nice. Yeah, that's great. And then one more question just that goes off of that, and then I'll save the rest for a little bit later. Do you doing a if let's say you did do a SEP, that does complicate the backdoor Roth IRA, um,
Yeah.
the ability to do that and kind of wield the advantages of it, correct?
Yes. SEP IRA is much more difficult. Yeah, I would almost say that it's yeah, it's unlikely to be able to
Because
do it.
you're going to run into the pro rata rule, correct?
Yeah, you're gonna run into the
Okay.
pro rata rule, which
Okay.
is getting pretty deep into the tax stuff. But yeah, I
Yeah.
would high level solar 401k is gonna be a lot more easy to be able to do that.
Okay, awesome. Well, we'll save a few of the other questions for later as we kind of progress on.
Cool. Um, so one of my favorites is the Augusta rule. Um, so the Augusta rule comes from the golf major Augusta in Augusta National Park. And the reason for this is that a lot of people rent out their homes during this tournament. And what we can do in the tax code is that if you have a multi-member LLC or an S corp, what you can do is you can rent your home back to yourself. Um, why this is why this is amazing is because you can take the Airbnb going market rate for 14 days in the year, and you can basically rent it back to yourself, which now becomes an expense, is now deductible. Uh, and so, say for $1,000, you rent your home back, that's $14,000 reduction right there without really having to do anything. The main compliance that you need with this is that you need to have an actual business meeting in your home. So typically, that's why you need a multi-member LLC. Typically, two people, you and your spouse, will qualify. And if you want to invite friends or anyone else that's relatable to your business, a fellow physician or fellow real estate investor, and you just kind of document, hey, this is what we're talking about in terms of real estate investing, or these are the opportunities for locum gigs around my area, and you have that, and then you basically have an agreement between your S corp and your personal about renting it. then that's really kind of the main documentation. There's a couple other small, minute things, but we basically have templates for this, how to look up the Airbnb rates, how to get the documentation. But this is an easy, um, you know, 14K or so back by just doing the Augusta roll. See. Yeah, so we talked about home office a little bit, so I won't kind of go big into that. This is also something that you're probably naturally just doing day to day, and you don't likely realize it, but just making sure that that office is strictly for business, and how you're tracking what expenses are relatable in there is this money back in your pocket, essentially. I will say that home office is the number one audited item, and so it is very, very important to do this properly where you don't exploit it, where you don't suddenly say 30% of your house is your home office, because that's not going to be really realistic. We've done so many of these that we kind of have just a good gut understanding of what's pushing it, what's not. And so far, we've never had any audit issues to date. So knock on wood. Let's see. Yeah. So the other one is how do you minimize an audit? And so whenever you have a real estate property or your 1099, it's extremely important to separate personal and business expenses. You cannot commingle. The moment you commingle, two things happen. One, you pierce any protection that you may have from having an entity. Um, and the other is that now, if you do get audited, in any case, it's very hard to defend um, that, hey, this is a business expense or this is personal, right? And so it becomes a nightmare to deal with, and a lot of your business expenses are most likely can be ineligible. So just for good accounting, for peace of mind, everything with taxes is starts with good bookkeeping and accounting. And having your own business account, own business credit card, understanding what you can do and making sure that it is eligible and relatable to the business is extremely important. Because you don't want to make that simple mistake and then leave tens of thousands of dollars on the table as a result of that. Um, so I think in the interest of time, I'd like to actually go through a live example of a physician that we worked with. It's gonna be on a different slide, so I'm just gonna switch to that. But in the meantime, happy to answer another question as I pull that up.
Oh, sorry, I was muted. Um, Here's a question. What are tax benefits if you're a passive investor versus active investor? I'm assuming, and Lisa, correct me if I'm wrong, that you're referring to real estate.
Yeah, it's gonna depend. If you can just confirm if it's real estate or not, that'll be helpful.
Yes, real estate.
Yes. And so in the tax, like active income can be deducted against active expenses, right? So if you're passive, if you're then anything on the passive side in terms of losses or depreciation cannot be deducted against your W-2 or your primary income. That's why it's so important to do the rep status for long-term rentals, getting the 750 hours, or doing the 100 hours for the short-term rental, for example. Right? Because the goal at the end of the day is we're trying to make certain expenses or certain investments active so that you can deduct it against your primary income. One of the best examples of this is stocks. If you have losses in stocks or in crypto, you are not able to deduct that more than $3,000 against your actual income. And so we've seen many cases where individuals think that, okay, well, I had $40,000 in losses in Bitcoin. Why can't I just deduct it against my income? And you can't do that because it's passive. You're not actually managing the Bitcoin. You're not doing it day to day. And so that's kind of the limitation there. So almost got this pulled up.
No problem.
Can
Uh,
I can I ask you a related question?
Yeah.
So my question is, you talked about stocks that we can only take 3,000, but how about the option trading? The gains from option trading. Do you have any tax saving strategies on the gains from the option trading?
So gains from options trading is also passive. So um, if you have passive investments and those are losses, then they can offset against those passive gains. But anything with trading, unless you have trader status, which means you're a full-time trader, you will not be able to deduct it, right? Um, Hopefully that makes sense. But
Sure.
passive has to be with passive. That's
Okay. Thank you. Thanks.
uh, let's see.
quick question for you, even I think you can correct me if I'm wrong in this. Frank's asking to do backdoor Roth, do you pay taxes at the time of conversion? Um, and yeah, so you're contributing to the a traditional IRA first, but you're above the limits. You'll be paying, taxes on that. It's not pre-tax, and then you'll convert, and then it grows tax-free. And you've essentially already, paid the taxes on those via
Yep.
income tax, and by the time you're contributing the money.
Yep, that is exactly right. Cool. Can everyone see my screen?
Yes, maybe you can even, I don't know if you can blow it up anymore.
Let's see. Is that, oops, let's see. Still pretty small.
If you, it was getting bigger.
I'm trying to think. Okay. How's that?
Yeah, that's great.
Okay, cool. So I tweaked the name, so this is not a real person, but this is a real tax plan of this individual. Um, so just to go through this, this individual is a physician, mix of W-2 and 1099. They made 150,000 in W-2, which they're doing kind of part-time through a hospital, and then they're doing several different locum gigs, generating about 375,000. So 525,000 total income. They are single, so they are hitting the highest federal tax rate at 37%. Um, and once you kind of blend it through all the different tax rates, their effective tax rate is at 29%. They also live in a state that has 5% um, tax rate. So now, essentially, when you're single, I think it's about ballpark over 350,000, you're paying 37%. So they are paying 42% on about $175,000 of their income. So the goal was, okay, let's get this down as much as possible. And so the process that we kind of run through is first we look at, okay, what is your entity structure? Is a 1099 income sole proprietor? Is it LLC? Does it make sense to do S corp? In this example, we decided, okay, an S corp will actually make sense when we did the math. And so without getting too into the weeds, the S corp allows you to pay yourself a reasonable salary, and the remaining amount of that income, it does not have to pay self-employment tax and FICA. And at this income, there it's about 3.5%, 3.8% in FICA. Um, and so they're able to generate about $8,700 in cash back in their pocket just by doing the structure alone. They also did the Augusta rule that we talked about. Their home was, an Airbnb was about $900 or so, a little bit less. And so we structured it, we created the agreement, the rental agreement, and deducted 12,000 on that side. They also had one kid that was a teenager that we decided to employ through the year. Paid them 12,500. The kid is under the standard deduction, meaning that they pay no taxes, and this is a deduction as well. Also, based on this, they decided that they were going to contribute 50,000 to their um, um, solo 401k. And then QBI is it's a little bit tricky. It's basically means qualified business deduction, and so when you're a business owner, certain things in the calculation can especially with an S corp, can bring you down. And for example, in this current new tax bill, that QBI is increasing from 20 to 23%, meaning that 23% of your qualified business income will automatically gets a deduction, right? So that's pretty powerful. The reason why this is limited is because this individual, um, you know, had quite a bit of income, and so the QBI was more limited in that side. They also bought a real estate property that was the 500,000 that I mentioned. We did the cost segregation. Whenever you do a real estate investment and do accelerated depreciation, you have to get a report, which is the documentation that you need that says, okay, this is the amount that's building value, this is the amount that's land value, and this is how much you can accelerate for the year. And that's the support that we have that we need on the tax return. And so it was a $125,000 deduction that yielded about $46,000 back in cash back in their pocket. They used this in the following year, beginning of the year, actually a few months ago, to invest as a down payment into the next property. And so this is why it's so powerful because you compound, build assets, and it starts cash flowing. Um, they also invest in oil and gas, 50,000. This is actually about a 90% deduction. And so that's how they got to the 18,500 in savings. The other ones are a bit smaller, like the mileage, the travel. They bought a vehicle. So one of the cool things is that also this year, if you buy a vehicle that's over 6,000 pounds and it's business related, you can depreciate 100% of that vehicle. And a good example is recently someone bought a Tesla X. Tesla X is over 6,000 pounds. They paid about 115,000 for it. All 115,000 was treated as a deduction. That means that they effectively got about 40% off the Tesla X. Um, and so, yeah, so this is a great example of someone who opted in for all the strategies. It took work on their side as well as our side, deducted about 350,000 that yielded about $128,000 in cash back in their pocket. Um, but yeah, I mean, I think I know I covered a lot of info. I don't want to go too more into detail, but I'm really happy to just answer questions and talk through different things.
Yeah, no, that was great. Thanks, Laxman. Can you talk a little bit? This is just something I want to bring up a little bit more about the car because I get questions a lot about that in terms of how much needs to be used for business and the documentation required for that as well, because obviously that's kind of a ripe one for
Yeah.
people to take advantage of.
Yes. So you always have to kind of track how much is personal and how much business because the business side is what you can ultimately deduct, right? That percentage. And so I say if you have two cars, it's ideal to keep that second car as much business as possible. Especially in that first year, you need to be able to track, okay, we call an app called Miles IQ. So you put in the app, hey, I'm going from this destination to this destination. It tracks what it is, and you say what the trip is related to. But as long as you can keep that kind of documentation, it's going to be very supportive in terms of deducting, as much on the business side as possible. And so, for example, like, I personally bought a car over 6,000 pounds, deducted it, and I told my wife, we are only using this car for business related items. I don't want to even have any portion go to the personal side, which I can deduct. And so we use our other car for all kind of the family, the kids, all these things. And we were able to deduct 100% of it, and everything was pretty easily documented to support that.
Very cool. Um, we actually have two questions on the same thing. Kind of when does it make sense to form an S corp versus sole proprietor LLC? Does it depend on how much 1099 income you're making? What's kind of the calculus there?
Yeah, great question. So the goal with an S corp is to bypass as much self-employment taxes and FICA taxes as possible. Um, and so, for example, when I see a physician who's making W-2 and they're probably making, so 180,000 is the Social Security limit. That means that's when you're really hitting a lot of your self-employment, and Social Security taxes. After that, it's really the FICA taxes that you don't have to pay taxes on in an S corp. And so every 100,000, it's about $2,800. And after about 350,000 total income, it goes up to 3.8%, so 3,800. But with an S corp, it's very important to know that there's more administrative work. You have to have a payroll system as well, which costs about $1,500 a year. It's an additional filing. There's more things to keep track of. And so overall, I would say the cost in terms of your time, in terms of fees and payroll, is a few $1,000s. And so it really depends on you. Is like, okay, am I going to save more than that amount? Is it worth it to me? If you're purely 1099, I think an S corp is almost a no-brainer. I say almost because there are situations where it may not make sense to do that. For example, if you're making $1 million, the reasonable income, you have to pay yourself a reasonable salary still that you pay all the normal taxes on. The other portion is what you don't pay the self-employment and the FICA. If you're going to make $1 million, you can't pay yourself a $100,000 salary. You're probably going to be 300, 400,000. That means you're already paying all the self-employment taxes. All you're really saving is the FICA, which can be $10,000 or so, but that's a more personal decision if that's actually worth it for you or not. The math says yes, I'm going to save a few $1,000s, then yes. But if you're making 300,000 or 400,000 and you can get under the Social Security income limit of 180,000, then it'll almost always make sense.
Okay. Um, This is kind of going back to when we were talking about the SEP IRA and the backdoor Roth. Bryce is asking, I was told by another CPA that you can do a backdoor Roth and SEP IRA if you have an LLC or S corp because the SEP IRA is with the business account and the backdoor Roth is a personal account. Um, is that true or not?
So there are the cases where you can do it with the separate, but again, it very much depends on the bank that you're with. That bank has to be able to allow for like conversion, right? And so a lot of the banks that I've seen typically do not allow that for SEP IRA. But yeah, I mean, as long as you kind of verify with the bank, it's definitely um, doable.
Okay, awesome. And then as we're kind of bumping up on our time, Frank had asked before, is there a guarantee you offer? So maybe you can talk a little bit about kind of like how the Doc Wealth model works, and also how people, if they have questions, can get in contact with you and things like that.
Yeah. So we've never had like a guarantee, but with the 400 physicians that we work with, we've had a 100% success rate in terms of saving more money than what we get paid. Our fee structure really kind of starts around the $3,800 mark. So it's pretty low in terms of tax planning, tax strategists, and it includes the tax filing as well. And as I mentioned and showed you the examples, it's pretty quick to be able to save $3,800. So there's not a lot of doubt in my mind if you're even interested or in doing tax strategy that you'll easily save that amount. On top of that, everyone pays for tax filing services anyway, right? And that's kind of included, as well as we're probably going to save you a ton of time and just education on how to navigate everything. Um, in terms of reaching out to us, our website is docwealth.io. I think I'll also share my information with Jordan as well that, he can share out. Um, but yeah, looking forward to working with you and saving you money.
Awesome. Yeah, I'll include your email address with the replay of the webinar as well when I send it out. No, thank you. That was incredible. Obviously a very comprehensive look at different options available. So thank you so much for taking the time, Laxman, and then everyone, thank you for joining and also asking such good questions and stimulating such good conversation. So thank you all and have a good night.
Thanks, Jordan. Thanks, everyone. Take care. Good night.